Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. It's the final trading day in November, and earlier we got several key data points for the Japanese economy. First, there was Tokyo CPI. Core inflation in the Japanese capital was up in the month of November at an annual rate of 2.8%. Now, core excludes fresh food, but the forecast was only for an increase of 2.7%, so a bit hotter than expected in that regard. And this obviously would support a potential rate hike from the Bank of Japan. For a closer look now at markets in the Asia Pacific, I'm joined by Bloomberg's Paul Dobson. Paul is executive editor for Asia Markets. He joins from our studios in Singapore. So what do you think? Is this enough, this reading on core CPI for Tokyo, enough to move the needle when we're considering a BOJ rate hike in December?
It still feels to me a little bit, Doug, like it's too early for the Bank of Japan. You know, they've backed down, they've been reticent, they've taken their time so far. Yes, there's plenty of evidence that there's an opportunity here to raise interest rates, but the market expectation really isn't there, and they tend not to move when that isn't priced in. And I think that there's a couple of reasons. One, they don't want to get in the way of the politics and let Takaichi kind of set out her plan and her course before they make their next move. They don't want to slow the economy too much while she's still bedding in, as it were. And I think that the other reason is that their longer term outlook for inflation is that it's going to slow and come back towards target as well. So they want to be a little bit careful on that too. Now, you know, that's despite the evidence that actually the inflation is still quite high and the cost of living is rising, and food price inflation, which isn't included in that core number, is also high at the moment. And one of the things that Takaichi actually wants to do is to put in place measures to kind of counter that on the fiscal side rather than on the monetary side. So my view is, and I guess the market view is, that the Bank of Japan isn't getting ready to move in December, but probably at the start of next year would be a more realistic kind of a timeline. And you can see that, by the way, in the yen in particular, which remains kind of weak and under pressure rather than starting to appreciate again.
From what I understand, Governor Ueda will be speaking next week, and we'll see whether or not he endorses the notion of a rate hike. I found it interesting that some of the other data points for Japan were far above forecast. Industrial output at a gain of 1.4%. The street was looking for contraction, and the retail sales number with an annual increase of 1.7% was almost double forecast. So there is a lot to be said about the health of the Japanese economy, despite this situation with tariffs that have been imposed by the U.S.
And that weak yen that I was talking about certainly helps that as well, kind of gives the exporters in particular a little bit more of a boost. It's an interesting situation, the economy at the moment. Sort of half looks good, half doesn't look quite so good. And, you know, kind of a little bit like we see in the US with that K-shaped economy. You know, there's pockets where things are looking better than in other places there. So, you know, we've seen in the stock market pretty decent signs of strength as well. But there's lots of tensions playing out under the surface, particularly in the currency market and also, of course, in the Japanese government bond space. Really importantly, this week we heard some more about the extra spending plans from the government, what it plans to do, how it plans to finance it. They haven't yet told us exactly how they plan to allocate the extra cash that they need to raise, and that will include some extra sales of government bonds. The market is asking them to put that in the short end of the yield curve and to actually slow the issuance at the back end of the yield curve where there really isn't that demand. And you've seen that in the very big increase in longer term interest rates, which is bad news for Japan because it raises the overall cost of financing on the long term too. What about tension between Japan and China, particularly after Prime Minister Takaichi's comments on Taiwan? It's been a fascinating thing to watch, hasn't it? I think from a market perspective, it's hard to read too much into it just yet, but certainly this idea that China had that call with Trump, and then Trump had the call with Takaichi, and apparently asked her to just cool things a little bit, does talk a lot to policy between US and China relations, how important it is for Trump to sell these agricultural products into China, and also what it means for the long-term future viability, prospects, and so on in Taiwan itself. And so we heard this week Taiwan talking some more about their own spending plans for defense and how, there's going to be lots of long-term investment going in to try to protect the island. But it probably is feeling a little bit more vulnerable at the moment. So I was watching actually the implied volatility on the Taiwan dollar, see if there's any pickup in stresses in financial markets there. So far hasn't really registered too much, but I do think that it's worth monitoring, particularly if you look at what the contours of the deal for peace in Russia and Ukraine might look like, and what that might mean as well for how safe and secure Taiwan feels from an investor's point of view and from a policymaker's point of view as well.
So as long as we're talking about China, Paul, I think we have to tease out what's been happening in the real estate sector. I guess it suffered another blow recently after China Vanke Co proposed delaying repayment on a local bond. Is this just kind of reinvigorating the anxiety that existed or has existed for years now when it comes to the property market?
It is, but it's surprising, I think, on three fronts, maybe. One, Vanke itself was one of the biggest property developers in China, and it was seen as a bit of a bellwether, as one of the last kind of companies standing without having defaulted for the market's potential recovery. Not only that, it has sort of semi or quasi-state links because of some of its shareholders being state-owned companies as well. And yet, the idea that it also is struggling to repay local debts, wants to extend some bond payments, maybe heading into more of a crunch for the bond market is a sign that, really the real estate market has not been sorted yet. It's still in a great deal of pain. And it's bad news for bondholders in that company and in any other company which has yet to default. It sort of tells you that repayment risks are still out there. And is bad, in terms of consumer confidence and the wealth effect, because what would really help reinvigorate the consumer in China would be a little bit more confidence in property, given that so much of the household wealth is tied up in real estate investments and house ownership. So that sort of weighs as a cloud on the economy. I think that there's one other thing that you can look at, though, which is this idea that actually that might not be such a terrible thing for the stock market. And it goes like this. One, for years and years, the first thing that Chinese people would look to invest in would be the real estate market because they saw the chance for continuing capital appreciation. And that's not been there for several years now. So that kind of confidence is gone. Two, trusting corporate bonds and the bond market in general, where yields are very low, is not so good at the moment. So three, what's the viable alternative? Maybe it's the equities market, which has had a really strong year this year, starting to look a little bit more appealing for people that are trying to find somewhere safe to put their cash, get some capital appreciation where they can't go in the real estate and can't go in the bond markets.
Paul, when we continue the conversation in a moment, I'd like to focus a little bit on the Fed cutting interest rates faster than the market previously thought, and maybe we can talk a bit about Bitcoin above 91,000 for the first time in a week. Speaking here with Paul Dobson, executive editor for Asia Markets on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner, speaking with Paul Dobson, executive editor for Asia Markets, joining from our studios in Singapore. So much of what we have seen stateside, Paul, in terms of this recovery or stability in the U.S. equity market has been tied to kind of further betting on the Fed cutting interest rates at the December meeting. I think the probability right now, if you look at money markets, about 80%. How does that filter into what you're seeing in the price action in Asia?
Asia's markets have also been buoyed by this. What we have is a weaker dollar as a result of the prospect of lower US interest rates. And so that's been boosting currencies in the region. And you have that sort of knock-on effect from the recovery in US equity markets also feeding into Asia. I think in particular, obviously, the tech market, which has had more of a wobble than most, starting to find a bit more stability. And because Asia's tech-heavy gauges, particularly South Korea, Taiwan, and Japan, are so dependent on those global supply chains and the prospects for AI development in the US and globally, that the recovery stateside has definitely had a beneficial impact on Asia's markets as well. So interesting, it's been such a wobbly month, and yet getting towards the end of it, I think on a global gauge, we're only 0.5% or thereabouts away from erasing all of the losses for November. So turning it into a positive month after all of the question marks that we've had would definitely be, kind of an interesting development.
Particularly when you look at how highly correlated the AI trade here is in the U.S. with, let's say, the South Korean equity market and names like SK Hynix and Samsung, and also Taiwan and TSMC.
Absolutely, absolutely. This kind of integral kind of part of the supply chain. I do think there's one interesting sort of additional thing that we saw over the past week or so, which is just a little bit of a fragmentation in terms of how people are viewing a future of AI. More concerns and doubts about one stack and more favorable for the other. The Google emergence, the strength of its new AI programs, and the prospect of it selling some of its chips, its TPUs, rather than NVIDIA chips, has kind of caused a little bit of a consternation, I think, among investors who are thinking, hang on a second, this looks like maybe there's some viable alternatives to NVIDIA and that supply chain, and to OpenAI and that supply chain. And so you're starting to see just people thinking about, where's the best opportunity within tech, rather than just trading tech as one big unanimous block.
When we look for signs of kind of the risk appetite returning, you don't have to look any farther than Bitcoin. And right now we're above 91,000 for the first time in about a week. In your neck of the woods, and I'm speaking to you from Singapore, how is the crypto market used as a leading indicator of appetite for risk?
It's really interesting, isn't it? Just how much it feels a bit like the tail wagging the dog or something like that at the moment, but how much those movements in crypto, fast trigger movements, give you that sort of insight into which way the wind is blowing. And so all of this drawdown that we've seen has certainly had more of an impact on mainstream markets than we might have seen in previous crypto booms and busts. I do think, it's more of a sentiment driven thing rather than a particular big wealth effect or anything like that thing. But I do also think that more of the real economy is invested in crypto now than it was previously. So there is some more direct read across, and people have been paying attention to it. Crypto itself, though, doesn't have that many fundamentals, so it is about sentiment. So I suppose if you're looking to discern the feel for the market, then that is a pretty true indicator.
So I mentioned the data points for Japan earlier, Tokyo CPI, along with industrial production and retail sales. What are the other important data points that you're going to be looking for on this final trading day in November?
Oh, good question. We have ECB minutes. People are wondering, are they going to try and squeeze another cutout at some point? We've seen so many policymakers being adamant that they're done, and yet maybe some arguments might start to come onto the horizon again, pointing in that direction. But otherwise, I think, what's going to be really interesting just is to see where we get to at month end. Can markets close out November in positive, or is it going to be the first down month that we've had for several months? And what does that tell us about what the prospects for that Santa rally that everybody who's bullish on equities is hoping for?
Paul, we'll leave it there. It's always a pleasure. Thanks so very much. Paul Dobson, Bloomberg executive editor for Asia Markets, joining from our studios in Singapore here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.